All right, welcome back to Business AM. I want to continue with the conversation this morning, and at this time, I want to introduce one more gentleman into our conversation this morning. I want to introduce Peter Wairegi, is the Chairman and Executive Director, Kenya Professional Realtors Association. Mr. Wairegi, welcome and thank you for joining us this morning.
Good morning, everyone.
Good morning. Fantastic. All right, so let's continue with the conversation this morning, where Centum Investment has now announced that it is selling land and property valued at 12 billion shillings to reduce its exposure to the real estate market, which has risen to represent 65% of its total assets in the year ended March. And the plan to bring in sales over 10 billion shillings in the next 3 years will see Centum get 2 billion shillings, but next year, March, with June indicating a 4 billion in some property sales. Its real estate assets include a 29.1% stake in Two Rivers Mall, land and residential developments in Kiambu, Kilifi, and Uganda. So, Mr. Wairegi, I want to pick your thoughts on that before I bring in the other gentlemen. I mean, when Centum is making this announcement and they're saying that they have been exposed by the real estate sector, what does it speak of the standing or the outlook of the real estate sector now within this pandemic?
Thank you. Again, beginning 2018, 2019, the real estate market has been underperforming. So I think, as you can see, Centum has invested probably over 50% of their portfolio in the real estate market, as you have correctly stated, both at Two Rivers in Uganda and Kilifi. I think the yield, as our colleague have said, has been low. The demand for office space and commercial has been low. Therefore, they are divesting their investment in that arena to other profitable investment opportunities. So I think, as the platform has also said, the real estate market now at COVID, where the sales had even dropped, which were already low. So it even made it more urgent for them to now divest themselves if they are going to continue as a going concern.
Fantastic. Mr. Wairegi, I'm going to come back to you so that you can actually give us the outlook of the sector from an inside-out perspective. But Abraham, I want to bring you in on this. I mean, if you go back to 2019, the real estate sector was hugely blamed for oversupply of office space. But if you look at what Centum is doing, Centum is saying, we are just going to sell some of the assets that we hold in the real estate sector so that we reduce that exposure. So who's going to buy? When in reality, what we're talking about right now is that real estate sector is underperforming. Can you sort of give us a picture of what Centum wants to do? Because they are still going to do real estate business.
You see, I think it was George or Gabriel who had said very well. The main reason a business is set up is to give a return to the shareholder. Now, Centum, with their current portfolio mix, will not give the required return to their shareholder. So they have their best. But there's something you said very interesting. Who will they sell it to? That kind of portfolio, who will you offload it to? That becomes the main issue. But more importantly, what is the outlook for the sector? Because now with COVID, and as another colleague has said here, that especially the office commercial space, the dynamics are changing, because quite a number of employers are saying, probably we don't need so many people in our offices anymore. So our demand for the office space will reduce. But also because of the impact of COVID, people are like the rental market has been hit. Everybody is on a discount. Then when it comes to property purchase, especially the high end and a bit of mid end, you're finding that is really coming down. And whether it's adjusting, whether it's a true market, I really cannot call it. But what is for sure, the prices are not where they used to be. The question is, are they going to go there anytime soon, if ever? But don't forget, the people who put their money based on those prices, either in terms of cost or in terms of expectations of the market. So that distortion is what now is making Centum do what they're doing, because their models don't work anymore. Because the models that they did were based on numbers that don't exist anymore. So the simplest way for them is to exit and hope that they get away with it. Whether they will or not, only time will tell.
All right, Gabriel, I want to bring you in on this as well. I mean, how attractive is the real estate sector right now in terms of a proper investment portfolio for anybody really looking to put their money somewhere? And what do you think that the COVID-19 pandemic has done to the real estate sector in the country now?
Okay, thank you. So, I mean, I think I'll make a call to my landlord because Abraham says everybody's on a discount. I'm not here.
Not on a discount, Gabriel.
I'll call it immediately after this. So the people who are going to be impacted, I think there are two streams of income from real estate investments. We have income, and then we have the capital gains. So, of course, the people who have been hit first and in a huge way by COVID are actually the people who rely on rental income or cash income from their real estate investment. And that's why we are all sticking to commercial space. We're sticking to retail spaces. So those ones have been affected. If you look at Centum, we're talking about two rivers, basically. Yeah, as much as in their last report they say they're at 80% occupancy, you can do the math and say, assuming they're giving a 30% rent discount, which can actually go upwards up to 50 for some, then they're losing some level of income there. But now, if you look at their other projects, and I like to segment any sector I'm analyzing, you can't have a broad brush for some of these sectors. Real estate banking. So real estate, we have the high end and we have the very low end. If you look at Centum, for example, their project in Vipingo, which I think I was following when they did launch it, they actually did register some very good sales for the smaller units because of they were very attractive at a price. The price point is actually very attractive. You know, we're talking 3.5 million, 4 million. So it's something that I know quite a number of people who are not, and I'm sorry to use the word, they're not savvy investors, but it's out of their own interest, and that's the market that people. I don't think these real estate developers target the savvy and investors who are calculating returns. So it's more of the Kenyan nature. So there's that whatever. So COVID is going to bring down the real estate market. The sales are going to be hard because of reduced purchasing power, but there's a bit of resistance from that Kenyan innate nature to just own a house, say it's real estate, buy land, buy a house, that is actually still propping up segments of this market. So the high-end ones are actually going to suffer because, for example, savvy investors who are probably wealthy are either going to buy into shares that are now at discounted prices, but the people who have a loan facility available, 4 million, 5 million, will go for anyone who's playing in that market. So the houses that go for 10 million upwards are going to struggle. That's a fact, because if you look at how much you actually have to repay for that loan, it's quite steep. But if you structure a 4 million loan for a house for 10 years, if you look at the repayments, they can actually end up being reasonable. So depending on the space these various projects by Centum are playing in, some are actually going to sustain. And if you look at, like, for example, I'm picking Vipingo, they have two sides. So there's one that is actually a bit on the low income category, low to mid, and then there's the high end one. So depending on those two, in even that one project, those two halves could perform very differently. But for sure, Two Rivers development is not going to perform equivalent to last year because of the income aspect. And then again, the other projects are also going to struggle a bit. But remember, these guys are developers. Yeah, developers make margins of up to 100%. That's something, and I think George can confirm or tell me otherwise. But yes, even if you were to cut a return of 100% to 50 and split it across a 3-year period, it's just that it's a delayed return. But depending on the price point you're playing at as a developer, you're likely to get away with it as a developer. But any asset that they have that is income is going to struggle a bit. But on their diversification from real estate, I mean, it's something that is coming, because if you look at their big wins in the past 5 years, they've all come from their private equity sales. That is what has given them the very big wins. So yes, that's why they need to start going back. That's why they have reducing their exposure to real estate so that they can start funding their private equity again, which has been a big winner for them.
Fantastic. Now, George, I want to bring you in before I bring in Mr. Wairegi on some of the key indicators that we're going to look at in 2020 as we go forward to 2021 that will sort of give us an indication of where the sector is headed. Now, I mean, yes, they're saying that they're pretty much sure that in the next 3 months, they're targeting 3 billion shillings of cashback. And then in 1 year, they are going to get back 10 billion shillings. Let's look at this plan. I mean, if you're talking about the effects of the COVID-19 pandemic and the economy rebounding, I think they're pretty much also laying their heavy plan on that, well, as we go back to next year, yes, the economy will start rebounding and there'll be more takers of some of these projects that we want to dispose of. Do you think that they're being overly optimistic since we're painting a gloom picture on some quarters of the real estate sector?
I think let me just give you a background, a small background before I go into that. I think for any investment bank or investment firm, you don't want to put all your eggs in one basket. So first things first, by Centum putting over 65% of their portfolio in real estate, that is already a huge risk. And I think they were looking at the risk vis-a-vis the return. Remember, the real estate sector was quite attractive in 2015, 16, 17, 18, and that informs the thinking behind them going very heavily into the real estate sector, and that's a risk that they took knowingly. Coming back to their forecast in terms of offloading some shares or some percentage of their portfolio in that sector, the way some of these projects are funded is that Centum will bring in a percentage of the capital injection, and then they'll attract some other financiers, be they onshore or offshore, to bring in capital into some of these projects. For example, if you look at the way Two Rivers Mall was financed, I know there were offshore financiers into that project. So I think what they're trying to do is to package that project in such a way that they can sell a stake to some of these offshore PE funds, so that they reduce their portfolio in that project. I think Centum are being what I call being cheeky investors. They know that the real estate sector is not going to perform very well in the next 1 or 2 years, but the reason they are giving for wanting to offload their shares in that is that they already have 65% portfolio in real estate sector. I think they have just done their forecast and gotten to a point to know that maybe the return that they are projecting from real estate is not going to be feasible. So they're trying to offload that risk to somebody else. As to whether they'll be able to plow back some of these monies into their coffers is still out there. But I know with the mix of their financials, I think it is able. They could not reach the 3 billion that they are forecasting, but I know they can do 50-60% of what they plan to offload. I know they're not going to offload it locally, but they are going to offload it to PE funds that are offshore.
Pretty much, Mr. Wairegi, therefore, it's time for you to come in, therefore, and sort of explain from an inside sort of outlook. What are the chances for this sector this year? I mean, we have been struggling since 2018 all the way to 2019. And there's this thing that exists within your sector where you keep on complaining. First, we didn't have the cap on interest rates. You complain about it. It was taken out, but the sector didn't rebound. COVID-19 is here. Is that going to be another area we're going to see another complaint coming from within the sector as well? What are the chances for this sector this year?
Thank you. Again, as your participants have stated, real estate is actually a long-term investment, not short-term investment. And then you have to divide from the high end to the low end. The majority of the people that are consuming real estate is actually the middle to low. So unless we change provide affordable housing for the masses, then you'll find that most developers will still continue to suffer, especially in the short term. In the long term, I think if now Centum divest themselves and they get an offshore PE, the offshore lenders are looking, or investors are looking for longer term returns, where they're willing to wait. Because as you know, real estate is a sure investment if you're looking in the long term, because the demand for real estate continues to grow as population grow. So if you look at the international market like Dubai, Europe, and US, real estate has continued to be a stable investment portfolio. So therefore, as but participants have said here, if Centum then was to divest, they're looking for short-term gains to balance their books in terms of their returns in the last 3 years. And I don't see that this is necessarily affecting real estate demand or market necessarily, other than the short run. In the longer run, real estate is the key because, as you know, as population continue to grow, the demand for real estate continue also to grow. So for me, I see this is a temporary blip. Maybe I would say the first 2 years, beginning 2021, 22, 23, I think the market will start to come back up when the sales market now opens again after we have a handle on the COVID. So to me, this is a temporary grip, and I see some potential growth in the long term.
Yes, Mr. Wairegi, just to allow me get back to you on that as well. I mean, when we're talking about now, I mean, we do know that even when we're talking about the housing deficiency in the country, we still do have it, and it keeps on growing by the day. So what is selling now in the real estate sector? Because you can't say, well, it's not in demand at all.
Well, what is selling is, again, the middle to low. As you can see, maybe participants have seen, during COVID, construction for real estate continued, especially housing. Again, there are several other developers who has come in, artists here at Garden City Mall with Mivido. They have sold 80% of the units have been sold. Afra in the river is selling. So again, it's the price point. And what we are failing to discuss is this affordable housing idea that everybody needs a home. I mean, I know our colleague has said that they're looking for rents to be reduced. Maybe they need to think about buying and owning a home. And there's also the question of affordability in terms of the cost of money. So if we can manage the interests and the government can actually bring incentives, as other countries have done in the UK and the US, you can see that this market will bounce back because the demand continues to grow.
All right, Abraham, let me get your sentiments on that as well. So somebody's going to ask you, Abraham, I mean, what should we be looking at? Well, everybody is overly optimistic. You can hear Mr. Wairegi saying, well, yes, we do expect that once the market opens up towards the end of the year or towards the second quarter of next year, then you can actually see the real estate sector is going to come back again. But what would be the indicators that are going to show us that, yes, it's in the right track?
I think my take, given the mismatch we've been having in supply, I think going forward, I think it will be better for the supply to be driven by demand. Because previously, most of the time, what's been happening is that we've had this notion of if we build them, they'll come. And I think that model has fallen for a face plan. So I think it's time now we started saying which sectors, and I agree with him that clearly the lower end is grossly undersupplied. The people, houses of between 0 to 5 million. I think that sector, if you build them, they'll come. But now, as Gabriel was saying, the 10 million plus, that one you really have to, by the time you're putting your first shilling in, you must know who's going to buy that. And also you're seeing the Kilimani, the Kileleshwa glut. That is driven by that. People are just putting them up and hoping that they'll come, and they never came. So if we go for demand-driven, the supply, then we will be just fine. The supply that's already in the market will correct itself, as he's saying that over time, yes, but that supply has to first live in the book. But the lower end, even now as we speak, it's still undersupplied.
Pretty much. All right. Now, Gabriel, 2019 did shape as a hit and miss year for the sector that was heavily blamed on oversupply of office space. Now, when you're talking about maybe the sector being in a correction phase now, so what indicators are we going to look at to confirm this trend this year? That since 2019 to where we are up to now, we are still in the correction phase, and you can see that's what Centum is doing. They're sort of trying to correct their mistakes to sort of reduce the exposure in the sector. What other indicators would sort of point out to, well, it is in the correction phase?
Okay, so for me, one of the biggest indicators would be looking at projects that are actually approved and those that are actually dropped. For example, I think last year Zamara dropped, they were planning to set up an office block here in Westlands, and they actually dropped those plans. They were actually hit by a bill by the developer, but they had to stop the plans because they realized there's oversupply. Starting a project now is not going to be profitable. I think Britam has also agreed that they're going to require less space. They've actually come out and said they'll require less office space because of how they've transitioned to working from home. So the indicators I'd look out for is other than occupancy, which unfortunately can be flawed because I'm the one who's telling you what's my occupancy. So actually the approval and establishment of new locations. So you need to look at the approval for new office blocks. So that if it decreases over time, should be able to tell you that we are having a slowdown in that space. I don't know if you're with us, Elijah.
Yes, I'm with you, Gabriel.
Okay, good. Yeah. So that's one. I mean, new developments in that category is what would be a very key signal in that, because tenants do move from one office space to another. They do expand, take up another floor. So the existing buildings, and like I said, you can't rely on the occupancy level some of them report, but I believe by monitoring the new developments, that could give us an indication. But just to mention something on what Abraham was saying in terms of the residential real estate, if you look at, and I think I was confusing the company Abraham works for, but there are two companies that we can speak of that have actually changed their business model completely. They're no longer doing the structure where you go get a bank loan and come buy the house. They're actually the ones who you pay rent to, of course not rent, you pay an amount with an interest on top, charging about 5 to 8% for 10 years to 20 years. And you actually end up owning the home. So instead of you going to a bank to get a loan, you just come to them directly, and their houses are what I would qualify as affordable houses, ranging from 3 bedrooms of 7 to 8 million shillings in suburbs of Ruaka, etc. So you find that such companies that you don't have to go to get a bank loan to acquire the house, they're changing. So the real estate sector is also pivoting. So the very smart people are actually changing strategy, because instead of you going to a bank, you come to us. Instead of paying rent of 30, you pay rent of 80, and in 10 years the house is yours, which makes more sense to a lot of people. And I think that is also going to come up in commercial spaces. We are seeing shared spaces becoming more common, whereby when you're building a house, you get 2 floors that the landlord actually operates as shared office space. People who can walk in and out at any point in time. Because, for example, if I was working from home and I'm a freelancer and I need to look good for this call, I might walk into an office space, pay for half day, and that's it. So it's that kind of thing. So they need to just pivot how they market these office space, because if we're a company of two, Abraham and I, we don't need a big office space with a coffee room with a boardroom. But if you're doing a shared office space for 2 whole floors, we don't need to book a specific space. We're sure any day we come in, we will get a desk and we will sit together and we will work, we will go home. The next day, no one is coming to office, we don't pay. So that's the pivoting that we need to see that has already happened in the residential. And I think the commercial has no choice but to pivot as well.
Pretty much. All right. Now, George, just before I bring in Mr. Peter Wairegi to cap this conversation, well, I mean, yes, what is therefore your general outlook for the sector, George, as we speak this morning?
I think I want to agree with Gabriel and Abraham that the real estate sector, the supply overstripped the demand. But when you look at the demand side, I think the demand for houses, people want houses. Almost, I think it's something that is there, that is given, that we always want to get a home. But what happens is, do you have the income to afford that home? If you look at between 2002 and 2011, I think there was a lot of private sector credit that went into real estate, both to the developers and also now to the buyers, and that balanced it off, so that as developers get facilities to build, to put up these properties, the buyers got similar facilities to go and buy these units. But this private sector lending to this sector, I think, dried up at certain point, and that is what brought the demand down. Two, you look at the disposable incomes across the country. I think between 2018 to date, the country's, what we call the households' disposable incomes have gone down. In fact, people have lost jobs between that period, and therefore there is the question of affordability. Can we afford to buy a house at this moment? And those are the things that have eventually affected now the demand for residential houses and even for commercial space. I would want to go and rent a commercial space, but can I afford it? Does my business allow me to afford that space? So those are the issues that I think, as an economy or as central bank, must address if they were to bring up this sector back to where it was in the previous years. So I think, Elijah, that is my take on that. But again, I want to agree with Abraham that players in that sector must now start remodeling their businesses so that it responds to what the market is demanding. The market is demanding for the lower end units. That is what they should supply, as opposed to the upper. The upmarket units, and then the financing models. If I was to be a player in that sector today, as I develop, I would want to address the demand side by just modeling my business in such a way that I can finance my buyers to come and buy my property. I think that is where the market is going, and anybody who will be able to crack that will be able to get back to get returns in that market. Elijah.
Pretty much, Mr. Wairegi capped this conversation for us then. I mean, we do know that the government was actually deep within the drive for affordable housing within the economy. Do you think, because yes, we do know that they have one financial year to go, do you think that towards the end of the Jubilee government tenure, that when they're going to look back and say, well, what can we do so that we have some sort of numbers and affordable housing, that this is going to actually drive investors towards this direction?
Let me also comment on what Gabriel said about the purchase money owner financing. It's what the trend has helped in other markets, both in Dubai, in UK and US, where you can actually do what is called rent to own or purchase money, which means the developer, the investor, finances the project to their potential buyers over time. So I think that will help in this market. But let me comment on what you're talking about, affordable housing. Affordable housing is misunderstood by many Kenyans. Affordability doesn't mean cheap housing. Affordability means access to be able to purchase a property in the lower end. But I think sometimes when you hear affordable housing, we think about cheap housing or social housing. That's not what it means. Even for an investor, some investors, as the panels are seated here, if they were to buy a home, they would shop for the best prices in the proper locations. So let me also say what question you raised about the government. They have done a very poor job in terms of bringing affordable housing to reality. When I was in America, they said housing, owning a home is the American dream. I think for many Kenyans, owning a home or having a piece of land is also the Kenyan dream. But if the demands at the time they started this, as you mentioned, in 2017, the demand was 2.5, growing at about 7 to 10%. The demand now may be 3 to 4 million, yet the number of housing they have been able to do is about 500,000. So, by the time Jubilee is off the office, they will not have met the demand. They told us of about 2.5 to 3 million demand because they have not been able to do that. So you can see we need more private sector initiatives to actually bring this affordable housing to reality. And this is going to take some time, but let me suggest that our industry continue also to suffer from lower professionalism in terms of, in Kenya, if you're buying a house, you're not sure if you give somebody money, you'll get a home. We need to raise the bar in terms of also the industry policing itself, creating some regulations that work so that we can protect the wananchi when they put money in any project as you've had, there are a few projects which are not finished. All this idea of selling property before they are done, then you've had with this, I don't want to mention their name, in Kenyatta Road, a lot of people put money, but the homes are not there. Yet they were fronted as affordable housing, 3.9, 4 to 5 million, yet they are not delivering them. So we have a lot of credibility issue also in real estate, as we are having in government, in terms of reaching this affordable housing threshold.
Very much. Mr. Peter Wairegi is the Chairman and Executive Director, Kenya Professional Realtors Association. Thank you very much for joining us this morning. We were also joined by Abraham Udhago, the CEO, Miradi Capital, Gabriel Mwendwa, Investment Associate, Horizon Africa Capital, and George Bunga, Managing Partner, AMG Kenya. That has been our economic review. You can take the gentleman back to the time that he came to the studio, 2146, but also on all our social media platforms at Metropole TVKE, across all of them. My name is Simba Elijah Charles Kiage. Good morning.